Hello there. The warnings are flooding in. We are on the verge of a mortgage calamity. As interest rates rise, so inevitably do mortgage rates. And the current month-upon-month rise in the bank rate, as set by the Bank of England, has started the clock on a mortgage time bomb. A time bomb that will hit the borrower hard, but not so much the banks, if at all. And the problem here is some of the effect of those rate rises have not yet filtered through to the borrowers, as only those on variable rate mortgages or those taking out a new mortgage will feel the pain of those rising rates. And new mortgages, as well as having higher rates, may have lower loan-to-value rates so that borrowers have to put more of a lump sum in. But the Office for National Statistics says that the Bank of England data also show that most mortgages are agreed at a fixed interest rate, where the interest rates stay the same for the duration of the mortgage deal, with 86% of outstanding UK mortgages being repaid at fixed interest rates in Q3 2022. This is up from 51% in Q1 2016. So anyone who fixed their rate before the recent rises will get a very sudden, huge shock when they go to a lender for their next deal. And in the second quarter of this year, from April to June, some 353,000 fixed-rate mortgages will either have been renewed in some way or the customer is now on the bank's variable rate. And this is causing disquiet in some quarters and growing calls for the government to step in with taxpayers' money and help prevent repossessions. But the PM Rishi Sunak says no, as a mortgage relief fund would make matters worse. And the Bank of England agrees that it would be a bad move on the basis that this pours more money into the housing market while shielding borrowers from the full effect of the rate rises, so fueling inflation further, causing even more bank rate rises in the future. Right now, the best way forwards for a mortgage borrower is to get rid of all the luxuries you don't need today, and start either overpaying your mortgage, if you can, or putting the money aside to pay off what you can as part of the remortgage process. If you're unable to do that now, then you will be unable to afford a new mortgage at these now normalised higher interest rates. Yes, these new rates are the sorts of numbers borrowers were used to in previous decades, and the mortgages back then were usually of the variable type. But government responses to the credit crunch with things like quantitative easing and near-zero interest rates led to cheap money, which has subsequently inflated the housing bubble to bursting point. The era of cheap money now appears to be over. And this also applies to buy-to-let landlords who leverage their business through mortgages. And that's on top of the increased red tape and costs they now have to endure, including the move by government to ditch the Section 21 no-fault evictions. And all this has led to many small-scale landlords to get out of the now loss-making venture. And this whole mix is turning into a perfect storm of a house price crash, with talk of prices plunging up to 35% in the next few years. Something that makes matters worse, because if your mortgaged house falls in value, you might not have enough equity in it for new loans with newer loan-to-values. Worse, you might owe more than the house is actually worth, putting you at best on the bank's variable rate. Tory backbench MP Lucy Allen has warned of an upcoming mortgage catastrophe. Before politics, Lucy Allen worked as a chartered accountant during a 20-year career at PwC, specialising in insolvency during the 1990s housing crash and the 2008 credit crunch. She wrote on her website, "This is a mortgage catastrophe staring us in the face. While I still tell my constituents to speak to their lender and get debt advice from the Citizens Advice Bureau, if I were their financial advisor, my advice would be sell now while you still can. It's only going to get worse. Now, what you may not know is that some banks have registered as landlords, and so have some corporates, and they are engaged in large build-to-rent projects. So instead of profiting from a 25-year mortgage, a bank or other corporate investor will get a continual and index-linked income from their investment. And doing it at scale, they have the lawyers to deal with the red tape and can afford some of the extra costs, something I talked about at the end of last year. And Conversation.com did a piece on this and pointed to Manchester, where, in the City Regional Centre, which includes Manchester City Centre, Salford Quays, Central Salford and the Pomona area of Trafford, out of 45,000 new housing units built between 2012 and 2020, 22,984 were build to rent. Nearly half, and it's increasing. In fact, the forecast is that it will double in size in the next 3 years, with The Telegraph quoting Emma Ross, Associate Director for Living Research at JLL, as saying, "We are going to see a shift away from small landlords, and that is going to be replaced with large landlords. The professionalisation of the sector." And I'm wondering how long it is before distressed mortgage holders are approached by a big corporate to buy the house from under them in return for them staying and paying rent to continue living there instead of paying a mortgage. Something that would get the government off the hook. In fact, Build to Rent already has government blessing in the form of a £1 billion Build to Rent fund and the easing of planning rules. Wonder if there are now moves quietly being put together for the banks and corporates to help the government out in this sort of form. More of the "you will own nothing and be happy" type of stuff. If the housing market does start sliding, the buyers first in line may well be corporate landlords with deep pockets snapping up homes that distressed sellers are trying to shift. And for those who also keep a large amount of debt on their credit cards, life will now be doubly hard, with some tough decisions to be made. And some will end up defaulting on something and trashing their credit history, leading to any future borrowing being at an even higher interest rate, if they can find a lender who will offer them anything. If rates go higher as expected, I think we'll start seeing houses coming onto the market more and more, with too few first-time buyers with true house purchasing power. Worse, some people in large houses might try to downsize, putting more demand pressure on the smaller units, keeping their values higher, while the cost of bigger houses starts to fall. Now, when the housing market seizes up, apart from financial advisors losing money, it affects things like job mobility. It tends to lock people into their current post. But if everybody is renting, they are much more mobile, a big benefit for employers and the government and the economy. But our government would never pursue such a WEF-style policy, would it?